Welcome to Talk Tickers, where we cut through the noise of earnings season to give you the insights that matter.
Today we're breaking down the Q3 2025 earnings call for LivaNova PLC. That's ticker LIVN.
And this one, it's a really interesting one, right? The call was pre-market November 5th.
It's a classic divergence. You have management delivering what looks like a home run quarter-strong operational beats, raised guidance.
And then you have the market reaction, which was not great.
Not great, is putting it mildly. The stock got hit and hit hard. So our mission today is to figure out why. Why did the market completely ignore the good news?
Okay, let's start with those good news headlines. Because they were solid. Revenue came in at, what, $357.8 million?
Yeah, and they comfortably beat the consensus, which was sitting around $342.7 million.
Yeah.
But the key number for me is the organic growth.
Right.
12.5% year over year. That's a really robust number.
And that strength flowed right down to the bottom line. The adjusted EPS was $1.11.
Which just blew past what the street was looking for. I mean, they were expecting something like 91, 92 cents.
So that's a 23% jump in adjusted profit year over year. You look at those two numbers in a vacuum, and you think this stock should be flying.
You'd think so. But it wasn't. After a tiny little pre-market bump, the stock closed the day down almost 5.8%.
And on heavy volume, too. 2.5 times the average. That's not just a little profit taking, that's real selling pressure.
And that's the paradox. The whole story hinges on GAAP profitability. That's where the skepticism comes in.
The GAAP versus non-GAAP debate. So the adjusted numbers were great, but the official accounting number was?
It was a miss. GAAP EPS came in at 0.0949 cents, and some of the more GAAP-focused models were looking for something closer to 0.55 cents.
So even with all the operational wins, the market is just zeroed in on that GAAP figure.
It's a signal, Investors are saying they're tired of backing out all these expenses. They want to see clean, unadjusted profit.
Okay, so how did management try to counter that narrative? What did they point to prove they're actually executing with discipline?
Operating leverage. It's the key phrase. They made it very clear that their adjusted operating income grew faster than sales.
Which is exactly what you want to see.
Right. The adjusted operating margin expanded by 250 basis points. It hit 23% for the quarter. That tells you they have pricing power and they're managing costs well.
That's solid. But the real story, I think, the thing that makes the sell-off so confusing, is the cash flow.
Oh, absolutely. This is the undeniable proof point. I mean, we've all seen companies post great adjusted earnings that don't turn into actual cash.
Is that the case here?
Not at all. Adjusted free cash flow for the quarter was $62 million. But look at the year-to-date number.
Go on.
$130 million. Now get this. In the same period last year, they generated just $11 million.
Wow. Okay, so that's a massive turnaround. $100 million plus swing.
Colossal. And it wasn't just from higher sales. They specifically called out disciplined working capital management.
So they're collecting money faster, managing inventory better, all the unglamorous stuff that actually builds a resilient company.
Exactly. And they use that cash to pay down $200 million in debt.
Yeah.
So they're de-risking the balance sheet at the same time. It's just a really strong operational story.
All right, let's get into the engines that are driving this, the two core segments. We'll start with cardiopulmonary, or CP. It grew 18% to over $203 million.
And the story in CP is all about one word, Essenz.
That's their next-gen heart-lung machine.
Precisely. And revenue from those machines grew over 20%. They're seeing a real acceleration in placements of the Essenz system.
What's driving that? Is it just newer tech, or is there something more to it?
It's better tech that leads to better outcomes and efficiency. It has a more modern interface. It's modular. Hospitals are paying a premium for it.
And management seems pretty bullish on it continuing.
Very. They expect Essenz to be 60% of all their heart-lung machine placements globally in 2025. That's up from 40% this year. It's a huge ramp.
And a big part of that ramp is a new market opening up.
China. It's their second biggest market for these machines. And they just launched Essenz there in August.
So that's a major future growth driver just coming online now.
Exactly. They said it'll start becoming a really meaningful contributor in 2026, so it de-risks the long-term growth picture for that whole segment.
But it's not all smooth sailing. There's a supply issue, right?
There is. With their oxygenator consumables, demand is great. They grew in the mid-teens, but they can't get enough third-party components.
A good problem to have, I guess.
It is, but it's still a cap on revenue.
Yeah.
They're trying to fix it, expanding their own capacity by 15% this year, but a new internal line won't be ready until the second half of 2026.
Okay, let's pivot to the other segment. Neuromodulation, or NM. It grew a bit slower, 6.9% to about $149.5 million.
Slower, but still solid. And this is all about their vagus nerve stimulation, or VNS, therapy for epilepsy.
Right, the implantable device to reduce seizures.
And execution there was actually really strong, especially overseas.
Yeah.
Europe and the rest of the world grew 12%, which outpaced the 5% they saw in the US.
They also talked about leveraging their clinical data.
The core VNS real-world data, yeah. That's crucial for getting doctors on board, showing them it works over the long term.
And there's a reimbursement catalyst coming.
A big one. Effective January 1st, the payment level for replacing old units is getting bumped up from level 4 to level 5. That makes the economics much more attractive for hospitals.
So you take all of this, the cash flow, the Essenz momentum, the VNS execution, and it's no surprise they raised guidance.
Right. They bumped up everything. Organic revenue growth now guided to 9.5 to 10.5%.
Adjusted EPS lifted to a range of $3.80 to $3.90.
And that all-important adjusted free cash flow, raised by $20 million to a new range of $160 to $180 million. It's a comprehensive upgrade.
And yet the stock still sold off. Which brings us to the bigger picture, the strategy. Management is basically using these two stable businesses to fund the future.
That's the whole thesis. They're using the cash from CP and epilepsy to make big bets on higher growth areas, specifically obstructive sleep apnea OSA and difficult to treat depression or DTD.
And that's where the GAAP spending comes from, right? The R&D costs for these new pipelines.
Exactly. They're sacrificing some short-term GAAP profit for what they hope will be a massive long-term payoff.
So let's talk about that payoff. For OSA, they're planning a U.S. launch in 2027. What are the expectations there?
The goals are ambitious. They're targeting $200 to $400 million in revenue from OSA by 2030.
Wow, that would be a huge new pillar for the company.
A huge pillar, and at a really high margin, too, over 25% operating margin. They are swinging for the fences with OSA.
And then there's DTD, which is probably even higher risk, but maybe higher reward. How's that progressing?
That one's a bit trickier. The market potential is enormous, but it all hinges on getting coverage from CMS, Medicare.
And there was a snag there.
A small one. They confirmed the process got paused briefly because of the government shutdown. It's just a little regulatory friction. They said to think about it as an 11-month process once they formally apply.
So that's a key timeline for investors to watch. But analysts on the call seemed more focused on something else, the Q4 guidance.
Yes. This was a major point of contention. If you do the math on the new full-year guide, it implies that Q4 earnings per share will be basically flat year over year.
And after 3 quarters of big beats, a flat Q4 makes investors really nervous. It signals something might be wrong.
It does. They worry about hidden costs or execution problems. But management was very direct about this. They said, yes, it's conservative, and they gave a specific reason.
Which was a planned investment.
A 10-cent per share planned investment in Q4. And this is the critical part to understand. It's not a cost overrun.
So what is it?
It's an upgrade. They're converting the printed circuit boards in the Essenz machines. Think of it as upgrading the hardware now so they can roll out more advanced software later.
Like AI features or better digital tools.
Exactly. They are spending 10 cents of margin this quarter to future-proof their fastest-growing product for years to come. It's a strategic investment, not an operational failure.
That completely reframes the Q4 guide. And they also mentioned that Q4 last year was a really tough comparison for heart-lung machines, which adds to the conservatism.
Right. And all this sets the stage perfectly for their big investor day on November 12th. They're basically saying, here's proof we can execute. Now come listen to our long-term plan.
Which they teased would include high single-digit plus revenue growth and an adjusted operating margin over 20% within 3 years.
A very compelling long-term story.
Okay, that brings us to our favorite segment, the one we call This Is Not Financial Advice.
And we have to say it, for education and entertainment purposes only. We are not recommending you buy or sell anything. This is just a thesis based on the call.
Got it. So the setup is this. The stock is down almost 6% on heavy volume. The market is obsessed with a GAAP miss and a conservative Q4 guide.
While completely ignoring the monster cash flow turnaround and the fact that the Q4 problem is actually a strategic investment in their best product.
It feels like a classic mispricing of information.
The market is penalizing them for investing in their future. The company just de-risked its core business right before it's about to lay out a really aggressive multi-year growth plan.
So the outrageous but plausible thesis is this. You initiate a tactical long position right now ahead of that November 12th investor day.
You're making a bet that once management lays out the full long-range plan, the market will have a light bulb moment.
realizing the Q4 issue isn't an issue at all.
Exactly. And they'll refocus on the real long-term catalysts. The Essenz ramp in China, the massive potential in OSA, and the incredible sustainable cash flow generation. The volatility is creating the opportunity.
Okay, to wrap it all up, LivaNova delivered a fantastic operational quarter, raised guidance across the board, but the stock got punished because of short-term GAAP concerns.
Yep, the core story is strong, but it was overshadowed. Management is clearly executing and investing for the future. So the question we want to leave you, the listener, with is this. LivaNova has already outperformed the medical devices ETF, IHI, over the last year. So does this sharp sell-off present a golden opportunity to buy a newly validated medtech growth story on sale? Or are the risks, the R&D burn, the uncertainty around getting that DTD depression therapy approved, still too high for the stock to really break out?
Something to think about. We'll be back with our next deep dive soon.